how much money do I actually need when I go buy my house? Well, the answer to that question is it kind of varies. It depends on your down payment, of course, and it depends on your closing costs. Those are the two things that are going to require cash when you go buy a house: down payment and closing costs. Your down payment is determined by the loan program and also determined by how much money is in your bank account. So you have minimum down payment programs. FHA requires a 3.5% down payment. Conventional usually is going to be 5%. USDA 0 and VA 0. Jumbo depends on the type of bank. So how much money is required for your down payment depends on the type of loan and how much money you want to put down. The only loan that it really matters when you get to 20% is conventional loans. Once you put down 20% on a conventional loan, you get rid of that thing that everybody hates, which is mortgage insurance. Now, how much money do I need for my closing costs? Closing costs consist of three things: prepaids, lender fees, and third-party fees. Well, what are these exactly? Well, lender fees is what the lender is charging you to do the loan. Sometimes they're called an underwriting fee. Sometimes it's a processing fee. You can call it origination. You can call it discount. There's all kinds of fun names that us banks try to throw in there just to make you feel better about it. But at the end of the day, it's what the lender is charging you to do the loan. Second portion is third-party fees. Third-party fees are fees that we pay to other people on your behalf to do the loan. For example, every house that you buy or sell is going to typically need an appraisal. So we're going to have to pay an appraiser to come out, look at your property, and tell us the value of the house. Well, what does that cost? Well, it depends on the vendor. So typically what you'll see is a lender will go out and say, okay, appraisal is going to cost $525. The appraiser shows up to your house, walks all through it, does their value, comes back and sends us an invoice. The invoice says it's $475. Well, as a lender, I can't charge you any more than what the invoice is, which is $475. So the vast majority of those third-party fees, appraisals, title, recording charges with the county, any of that stuff are going to be what we call pass-through fees. It's just something that somebody else is charging to do your loan. And all we can do legally is pass that fee on to you. We can't charge you any more, even though we disclose it at a higher level, because that's against the law. So third portion is, which is the biggest portion of your closing costs, are going to be your prepaids. Well, what are prepaids? Well, anytime you buy a house and you don't put 20% down, typically you're going to have an escrow account. An escrow account is an account that holds your taxes and your insurance throughout the year, that pays that bill when the bill comes due. So at the end of the year, or at the end of 12 months that you've lived in your home, I should say, you're going to have to pay for insurance again. Well, every month you've made a payment into your escrow account for your insurance, and then they pay your bill. Well, when you buy your house, you have to pay a lot of that stuff up front. Why is that? Well, insurance is paid forwards. So if you buy your house in August of 2020 and you live in that house for an entire year, you're paying for your insurance through August of 2021. And then every month that you make your payment, that money goes into an escrow account. So when August of 2021 shows up, they reach out and they pay that insurance bill for you. So when you buy your house initially, you have to pay for a full year in advance. Well, if your insurance premium is, say, $200 a month, that's $2,400 a year. Okay, so now we have to collect for 3 additional months of insurance and 3 months of taxes. Well, why is that? Well, the good news is when you buy your house, you get to skip a month as a payment. So if you close on your house in September of 2020, your first payment isn't going to be due until not October, that's the next month. November of 2020. You're going to skip that 1 month. So we have to collect for 1 month for that. The other 2 months are a 2-month federally mandated cushion that we have to put in that account. Why is that? Well, if anybody's ever been out there and said, well, my mortgage payment just shot up, the bank screwed me over, the lender changed my payment every single month and it's making me mad. Well, the reason is, more often than not, is because your taxes or your insurance went up. Most people today get fixed rate mortgages. When you get a fixed rate mortgage, your principal and interest does not change for 30 years to the penny. But what can change are your property taxes and your homeowners insurance. So every year, if your payment goes up, odds are it's because your property taxes went up or your homeowners insurance went up. And the bank can't predict what that number is going to be until the bill shows up. So when you buy your house, as a lender, we have to put a couple extra months in there for each one of those circumstances to make sure that if your insurance goes up or your taxes go up, that you have a little bit of cushion to offset that amount so you don't have to come out of pocket. We're required to do this. It's really not an option. The only time that you get an option to not do that escrow setup is if you put down 20%. Then it's up to you. But in the meantime, that portion of it, if you've got $200 for a monthly insurance premium and you have to pay for 1 year up front, that's $2,400. plus an additional 3 months, that's an additional $600. So just right there, there's $3,000 in insurance. What if you buy a house and your property taxes, like they are in Texas, are $500 a month? Well, that's $1,500 because we're collecting for 3 months of taxes. 1 month because you skip a payment and 2 months for the cushion. So right there, before you've paid for appraisals or lender fees or anything else, your closing costs are $3,000 for insurance and $1,500 for taxes. That's $4,500. On a $300,000 house, when you have a total closing cost of, let's say, $7,000 to $8,000, $4,000 to $5,000 of that, almost half of it, is going towards taxes and insurance. So that by far is the biggest portion of your closing costs. So when you look at when you go buy a house and you say, how much money do I need? Well, in this scenario, if we're buying a $200,000 house at 5% down, because that's what's required on a conventional loan, that's $10,000. That's your down payment. If that same house has a closing cost of $6,000, half of that being your taxes and insurance up front, that's $16,000. So in order to get into a $200,000 house with a 5% down payment and $6,000 in closing costs, you're gonna need $16,000. Now, where that money comes from and how you get it, I'll address in another video, but that's just to give you a frame of reference so you know how much cash it actually takes. If you have any other questions or want to make any comments, please share down below. In the meantime, I appreciate your time. Have a great day and be good humans. Talk to you soon.